Welcome back to Mission Success Women in Multifamily, the monthly podcast series dedicated to female leaders in the multifamily industry. I'm Laura Valean, Senior Editor with Multi-Housing News. We're well into the second half of the year, and the data is starting to paint a clearer picture of where the market might be headed. So what's next for multifamily? In this episode, we'll dive into insights from Newmark's latest capital markets report to explore how the sector could perform over the next 12 to 18 months, and what that means for you as an investor, developer, or lender. Joining me today is Sharon Karaffa, President of Multifamily Debt and Structured Finance for Newmark's Multifamily Capital Markets Division. Hi, Sharon. Thank you for accepting my invitation.
Oh, thank you. Thank you very much for having me. I'm looking forward to the discussion today.
Let's dive right into the latest data you have. Multifamily demand surged to almost 800,000 units annually as absorption remains strong. What are the primary drivers behind this historic absorption? And do you expect this momentum to continue into 2026?
Yes, yeah, we do expect this momentum to continue into 2026. Renting remains significantly more cost effective than home ownership right now. In fact, the spread between renting and home ownership in the US widened to $1,200 per month, which is 3 times the long-term average. So that combined with the high 30-year fixed rate mortgage, it's about 65% higher than the effective interest rate on outstanding mortgage debt. We would expect, the acquisition of single family homes to be, limited transaction volume until the rates come down. And we also have millennials and Gen Z in prime renting years. So we do expect that momentum to continue. Absorption will start to normalize as the supply pipelines deliver, but demand fundamentals remain intact, and we do expect the momentum to continue.
And meanwhile, vacancy rates dropped to 4.3%, well below the historical averages. What does this signal about pricing power and NOI growth potential in the near term?
Lower vacancy rates provide owners and operators with greater pricing power over time. So we would expect, the potential for NOI growth is strong. We would expect that there would be some NOI pop and some rent growth pop, particularly as occupancy stabilizes. We would start to see those rent increases.
Despite strong demand and low vacancy, rent growth has remained below 1%. Should investors interpret this as a temporary lag?
I don't think it's a structural shift at all. Rent growth would slow when supply peaks, which we've seen, and that's to be expected and normal. But as the units are absorbed and vacancy rates come down, which we've seen for sure, we would expect a rebound. And long-term fundamentals remain healthy. And so I think this is just a temporary lag as all of the supply gets absorbed, and certainly not a structural shift.
Okay. And looking at US markets specifically, those in the Sun Belt continue to dominate both demand and supply metrics. Are we approaching a saturation point in this region, or is there still runway for growth?
We believe long term, there's certainly runway for growth. The Sun Belt is attractive for homeowners and renters due to population and job growth. There may be certain metros that face near-term supply pressure, but overall, demand drivers continue to suggest that there's runway for growth. Investors will be evaluating micro markets and suburban versus urban or class A versus workforce. And so there may be pockets where there's more supply and slower growth, but we think overall the Sun Belt is a very attractive markets for investors and for renters.
Another aspect that's worth mentioning, starting from the latest report you released, is that Rust Belt markets like Milwaukee and Columbus have been showing strong absorption. Are they becoming more investable? What risks should investors weigh?
Yeah, we have seen investors move more into these markets for sure. Um, because of affordability and stable employment bases and perhaps lower supply growth in these markets, we've certainly seen investors move more into those Rust Belt markets. Um, the the risks could be that over the long term, the demographic growth is a little slower as compared to the Sun Belt, but these markets can provide great diversification and resilient yields. And I would say nationwide across the country, multifamily and rental fundamentals remain strong. And so they're going to continue to be strong. Just some markets may grow faster than others.
Mhm. One aspect that many experts have been worried about is the fact that construction starts are down 30.7% since 2022. How is the financing environment influencing new development pipelines?
Yeah, we've seen some projects perhaps be delayed. Banks have pulled back, so there's a little less liquidity in the construction financing world, although there certainly is other lending providers who step in to fill those gaps. But it could drive borrowing costs higher, credit standards a little tighter, and so that's limiting new development. But long term, this could support rent growth once the existing pipelines have fully delivered and stabilized.
Also, from the latest report that Newmark put out, originations rose 43% year over year, with the GSEs still leading. How do you see the role of GSEs evolving, especially as debt funds and insurance companies gain share?
Yeah, we see we are a top Fannie Mae and Freddie Mac lender. We see the agencies as providing a critical role in the market of providing liquidity and stability through all market cycles. Typically, the agencies represent roughly 40% of the multifamily financing market, sometimes more depending on the appetite of private capital and sometimes less. But this year, we've seen a very pro-business, pro-growth administration and leadership at both Fannie Mae and Freddie Mac. We see them pushing toward innovation and a desire to try to win and to maybe hit, they've got production caps, but there seems to be a desire to try to do as much business as they can toward those pricing caps and achieve and maybe exceed their housing goals. We expect the GSEs to remain a stabilizing force. Private capital fills in targeted areas. Um, and over time, banks, debt funds, life companies, CMBS kind of come to the market in areas that make sense for them and exit. The agencies are sort of there in every market through all cycles, providing that needed liquidity and affordability financing. So we see them as the backbone of multifamily financing, and believe that their role will continue to be as critical and important as it has historically been.
Meanwhile, bank participation has been dropping since 2023. What are the implications of this pullback for borrowers, especially in secondary and tertiary markets?
Yeah, those are the markets where borrowers are going to feel it most. Traditionally, banks have served secondary and tertiary markets, maybe less institutional borrowers and smaller deals, and so it will be felt there most. There are other lenders. Certainly, we see a lot of appetite for lenders across the country, and so there will be a reliance on alternative lenders, which may come at a higher price or with different terms than what those borrowers typically expect to see from their local banks. But we do see a lot of liquidity in the market.
But before more alternative lenders step in, banks hold 42% of maturities due between 2025 and 2027. In fact, roughly 25% of this year's maturities appear potentially troubled. How concerned should investors be about refinancing risk and potential distress in the near term?
Refinancing risk is real, particularly for deals that were acquired maybe at peak valuations and perhaps with floating rate debt or with cheaper debt than what's available today. However, a couple of things to also consider. Fundamentals in our industry have been very strong, as we've talked about. Vacancy levels are low. Rent growth is expected to start to tick up in the near term. And when you
Right.
combine this with lender willingness to work with borrowers, we've seen lenders work with borrowers through either perhaps extending loans or modifying loans. Um, this really helps us avoid some real, broad-based distress, which we don't expect. There may be targeted distress, there may be, cash in refinances, and there may be, there will be some pain felt by some borrowers, but we do think this would be more targeted and not really a broad-based, significant industry issue.
In this context, one-year extensions are quite common. Are these kicking the can down the road or providing meaningful breathing room for repositioning?
We think it's a little bit of both, and perhaps leaning more toward providing meaningful breathing room for repositioning. With each year, we're maybe able to see NOI improvements or a little bit of that rent bump that we've been talking about, and we're also perhaps maybe able to see more attractive interest rates on a refinance. So I think it's overall helpful. I don't think it's necessarily kicking the can where we're just ignoring the underlying issue. I think the fundamentals in the industry are strong, and each year will start to improve the fundamental issue at a property, which may be causing distress at any given moment.
Yeah, despite all the risks and challenges that we've talked about, multifamily remains the largest asset class by sales volume, and it is mainly because of those healthy fundamentals you've been telling me about. What's driving this capital concentration? Do you see any signs of overheating?
Um, I don't think so. I think that, multifamily is considered resilient, and we've seen this over past cycles that there's people always need a place to live, and so this
Right.
sector is viewed as very resilient. It's viewed as durable, and so we don't see overheating. We think the transaction activity that we're seeing reflects the confidence that investors have in multifamily's resiliency.
And given the macroeconomic backdrop and weak consumer sentiment around home buying that you told me about at the beginning of the conversation, what's your outlook for multifamily performance over the next 12 to 18 months?
Yeah, we think we will see strong performance. The rent growth will likely start to accelerate as supply pressure eases and absorption continues. Performance will be market specific. Certain markets have more supply than others. Certain markets have supply coming on while others don't. So it will be market specific, but overall, multifamily remains compelling. We talked about its resiliency and underlying fundamentals being really strong, particularly as interest rates remain high, home ownership becomes unfortunately a little out of reach or more expensive than renting. So we feel good about the multifamily industry for investors, for borrowers, and see a lot of positivity and growth in the near, medium, and long term in the industry.
Sharon, thank you so much for sharing all these insights.
Thank you.
Thank you all for listening. The next Mission Success episode will come online in the third week of October. But until then, you can check out multihousingnews.com for the latest news, feature stories, and podcasts. And I also encourage you to subscribe to our recently relaunched YouTube channel.